Good morning, good afternoon, good evening. Wherever you are, whatever time you're watching this, I want to speak with you about something that's unfolding right now in the silver market. And I need to be clear from the start. This isn't about panic. This isn't about rushing into decisions you'll regret tomorrow. This is about understanding what's actually happening beneath the surface of a price move that has caught many people off guard. If you own silver, you're probably watching your position with concern. If you've been considering silver, you're wondering if this moment changes everything. And if you've never thought about precious metals at all, you might be asking yourself why anyone is talking about a metal that doesn't pay dividends or interest. All of those questions are worth answering. Because what's happening right now isn't just about silver, it's about how markets respond to stress. It's about how governments manage impossible debt loads. It's about what happens when the narratives we've been told start colliding with economic reality. Something has shifted. Not overnight, but gradually, then suddenly. And the silver market is one of the first places where that shift is becoming visible. Let me walk you through what's really going on. Over the past several weeks, silver has experienced a price shock that many mainstream analysts didn't see coming. Not a slow drift. A sudden, sharp move that has forced portfolio managers, industrial buyers, and retail investors to reassess their assumptions. The price didn't move in isolation. It moved in response to a confluence of factors that had been building quietly for months. Currency volatility, central bank policy signals, supply chain pressures that never fully resolved from previous disruptions. And perhaps most importantly, a growing awareness among institutional investors that the old playbook may not work in the current environment. Here's what most people miss. Silver isn't just a precious metal, it's also an industrial commodity. It sits at the intersection of two powerful forces, the monetary system and the real economy. When those forces pull in different directions, silver becomes one of the most volatile assets you can own. Right now, those forces are pulling hard. On one side, you have governments around the world dealing with debt levels that were unthinkable a generation ago. Total global debt now exceeds $300 trillion. That's not a number that gets solved through austerity or growth alone. It requires something else. And historically, that something else has involved currency debasement, inflation, and a repricing of hard assets. On the other side, you have industrial demand for silver that continues to grow. Solar panels, electric vehicles, electronics, medical applications, defense technology. These aren't speculative uses. They're structural components of the modern economy, and many of them require silver in ways that can't be easily substituted. When you combine monetary pressure with industrial demand and limited supply elasticity, you get a market that can move violently in both directions. That's what we're seeing now. The typical investor looks at a price chart and sees chaos, a spike, a correction, noise. They try to find patterns in the short term, looking for signals that will tell them when to buy and when to sell. But that's not how you understand precious metals. That's not how you understand any market that's being shaped by forces larger than trader sentiment. Silver, like gold, like any asset that stores value outside the traditional financial system, moves in cycles that are measured in years, not weeks. Those cycles are driven by changes in monetary policy, shifts in confidence, and the slow accumulation of imbalances that eventually demand correction. We've been living through a period of unprecedented monetary expansion. Since the financial crisis of 2008, central banks have created more money than in all of human history combined. That's not hyperbole, that's simple arithmetic. For years, that money creation didn't lead to the inflation most economists expected. Why? Because the velocity of money collapsed. Because much of that liquidity stayed trapped in financial markets. Because globalization and technology kept downward pressure on consumer prices. But something changed. Supply chains seized. Energy prices surged. Labor markets tightened. And suddenly, that wall of liquidity started finding its way into real goods and services. Inflation returned, not the transitory kind, the persistent kind. Central banks responded the only way they know how. They raised interest rates, they tightened policy, they tried to cool demand without breaking the economy. And here's where it gets complicated. Higher interest rates make traditional safe assets, like bonds, more attractive. They pull money away from non-yielding assets, like precious metals. In theory, that should have crushed silver and gold. But theory collides with reality when the fundamentals shift. When investors start questioning whether bonds are truly safe in an environment of massive government debt. When they start wondering if currencies can maintain purchasing power when the fiscal situation looks unsolvable. That questioning creates a different kind of demand, not speculative demand, not momentum chasing, but demand rooted in a loss of confidence in the alternatives. Let me paint the broader picture, because you can't understand silver without understanding the system it exists within. We have a global financial architecture built on confidence. Confidence that governments can service their debts. Confidence that central banks can manage inflation without triggering recession. Confidence that currencies represent stable stores of value. That confidence is being tested right now in ways we haven't seen in decades. Look at the United States, the largest economy in the world. Debt to GDP ratio above 130%. Annual deficits that would have been unthinkable 20 years ago. Interest payments on the national debt that now exceed defense spending. The math doesn't work. You can't grow your way out when growth rates are slower than borrowing costs. You can't cut your way out when every program has a constituency that will fight to protect it. And you can't tax your way out without triggering capital flight and economic contraction. So what do? You inflate. You debase the currency slowly enough that most people don't notice until it's too late. You hope that nominal growth makes the debt burden more manageable, even if real purchasing power declines. This isn't conspiracy theory. This is how sovereign debt crises have been managed throughout history. From ancient Rome to Weimar Germany to every developing nation that's ever faced a balance sheet it couldn't honor. The difference now is that we're talking about reserve currencies. Currencies that the entire global financial system depends on. And when confidence in those currencies starts to waver, investors look for alternatives. Some turn to other currencies, but most major economies face similar challenges. Some turn to real estate, but property markets are already stretched in most developed nations. Some turn to stocks, but equity valuations are high by historical standards and vulnerable to economic slowdown. And some turn to hard assets, commodities, precious metals, things that can't be printed, things that have maintained value through every monetary crisis in recorded history. Silver has always been gold's volatile younger sibling. When gold moves 5%, silver might move 15%. When fear enters the market, silver often leads. When confidence returns, silver often falls harder. Why? Because silver is smaller. The entire above-ground silver market is a fraction of the gold market. It takes far less capital to move the price. That creates opportunity for those who understand the cycles, but it also creates risk for those who don't. Right now, we're seeing something interesting in investor psychology. There's a growing divide between paper silver and physical silver, between the contracts traded on futures exchanges and the actual metal sitting in vaults or moving through supply chains. For years, the paper market dominated price discovery. Traders could buy and sell exposure to silver without ever touching physical metal. That kept prices stable, efficient, and tied to traditional supply-demand metrics. But when trust in financial systems begins to erode, people start questioning the paper. They start wondering if their contracts are truly backed by metal. They start preferring physical possession over promises. We saw this dynamic accelerate in 2020 and 2021. Retail buyers flooded into physical silver, premiums spiked, delivery delays extended. Meanwhile, paper prices stayed relatively contained because the futures market remained liquid. That disconnect can only persist for so long. Eventually, if enough people demand physical delivery, if enough industrial users worry about availability, the paper market has to reflect reality. Some analysts believe we're approaching that inflection point. Others think the existing system can absorb the stress. The truth is, no one knows with certainty. But the tension is real, and it's worth understanding. History doesn't repeat, but it often rhymes. And silver has a long history of responding to monetary stress in predictable ways. In the 1970s, when inflation surged and confidence in the dollar wavered, silver went from under $2 an ounce to nearly $50 in less than a decade. That wasn't just speculation, it was a response to real economic conditions. Stagflation, oil shocks, currency instability. When those conditions resolved, when Paul Volcker raised rates high enough to break inflation's back, silver collapsed. It gave back most of its gains over the following years. That's the nature of volatile assets. They can take you to heights that feel euphoric and depths that feel devastating. In 2008, during the financial crisis, silver initially crashed along with everything else. But then, as central banks unleashed unprecedented stimulus, it rallied from under $9 to nearly $50 again by 2011. Another massive move driven by monetary policy and fear of systemic failure. And once again, when conditions normalized, when the immediate crisis passed, silver declined for years afterward. The pattern is clear. Silver moves in long cycles. It responds to changes in monetary conditions more than to short-term trading narratives. And it punishes those who buy at the top of emotional waves and rewards those who accumulate during periods of neglect. We've just come through a period of relative neglect. From 2013 to 2020, silver went nowhere. It ground lower, tested investor patience, and was largely ignored by mainstream finance. Then 2020 happened. The pandemic, the stimulus, the supply chain chaos, and silver woke up. Not to its old highs, but enough to signal that something was changing. Now, in 2026, we're in the next phase, the phase where the consequences of previous decisions start becoming undeniable, where the debt comes due, where inflation refuses to die quietly, where investors realize that the problems weren't solved, just postponed. If you're holding silver right now, you're probably experiencing a mix of emotions. Maybe vindication if you bought years ago, maybe anxiety if you bought recently, maybe confusion about what to do next. Let me offer some perspective. First, volatility is the price you pay for owning an asset that isn't correlated with traditional markets. Silver will swing more violently than bonds, more violently than most stocks, sometimes even more violently than gold. That's the nature of the asset. If you can't handle that volatility, you shouldn't be in silver. Second, the reason you own silver matters more than the price at any given moment. If you own it as insurance, as a hedge against monetary instability, then short-term price movements are noise. You're not trying to time the market. You're trying to protect purchasing power over the long term. If you own it as a speculation, hoping to catch a big move, then you need to be honest about your risk tolerance and exit strategy. Speculation isn't wrong, but it requires discipline. It requires knowing when enough is enough. It requires the emotional strength to take profits when everyone else is buying and to buy when everyone else is panicking. Third, understand that silver is not an investment in the traditional sense. It doesn't generate cash flow. It doesn't grow earnings. It sits there, storing value, waiting for the world to decide what it's worth. That makes it a poor choice for your entire portfolio, but it makes it a potentially valuable component of a diversified approach, especially in environments where traditional assets are vulnerable. Right now, with silver experiencing this price shock, the question isn't whether you should panic. The question is whether your original thesis for owning it still holds. If you bought silver because you believe monetary policy is unsustainable, has that changed? If you bought it because you see industrial demand growing while supply remains constrained, has that changed? If you bought it as insurance against currency debasement, has that risk disappeared? If your answers are no, then a price shock is just noise. If your answers are yes, then it's time to reassess. If you're watching this from the sidelines, you might be wondering if now is the time to get involved, or if you've already missed the move, or if this whole thing is just another bubble waiting to pop. Those are all reasonable questions. Here's what I'll tell you. Chasing momentum is almost never a good strategy. If your reason for buying silver is that the price just moved, you're already late. Markets don't reward people who show up after the party starts. They reward people who do the work, understand the fundamentals, and position themselves before the crowd arrives. That said, we're not at the end of a cycle here. We're potentially at the beginning of a much longer shift in how global markets function. If that's true, if we're entering a period of sustained monetary instability, then silver could have much further to run. But you need to go in with your eyes open. You need to understand that buying silver means accepting volatility. It means being willing to watch your position swing wildly. It means having the discipline not to sell at the worst possible time and not to buy at the worst possible time. Most importantly, it means sizing your position appropriately. Silver should never be your largest holding. It should never be money you need for daily expenses or short-term goals. It should be a portion of your portfolio that you can afford to see fluctuate without losing sleep. How much? That depends on your situation. Some analysts suggest 5 to 10% of investable assets in precious metals as a whole. Others suggest less. The right number is the number that lets you sleep at night while still providing meaningful protection if things go wrong. If you decide to buy, don't try to time the perfect entry. You won't. No one does. Instead, consider averaging in over time, buying regularly in smaller amounts, building a position gradually so you're not overly exposed to one price point, and focus on physical metal when possible, or instruments that are fully backed by physical metal. Avoid excessive leverage. Avoid complex derivatives you don't fully understand. Keep it simple. Keep it real. One thing we haven't discussed yet is the physical supply situation. And this matters, perhaps more than most investors realize. Silver is produced in two main ways. Primary silver mines, where silver is the main product, and as a byproduct of other mining operations, particularly copper, lead, and zinc mines. About 70% of silver supply comes from that second category, which means silver production is often dependent on the economics of other metals. When copper or zinc prices fall, those mines produce less, and silver supply falls as a side effect. We've been in a period of underinvestment in mining for years. New projects take a decade or more to bring online. Existing mines are aging, and the easy deposits have been found. Meanwhile, demand has been growing. Industrial demand alone consumes over half of annual production. And unlike jewelry or investment demand, industrial demand is relatively inelastic. Manufacturers need silver for their products. They can't simply decide not to buy because the price went up. This creates a structural tension. In years when investment demand surges, when people rush to buy coins and bars, supply can't adjust quickly. The market tightens. Premiums rise. Delivery delays extend. We saw this in 2020 and 2021. Mints couldn't keep up with demand. Dealers ran low on inventory. Premiums on physical silver reached levels that hadn't been seen in decades. If we're entering another period of strong investment demand on top of growing industrial demand, the supply picture could get very interesting very quickly. Does that mean prices must go higher? No. Markets are complex. Sentiment can shift. Demand can evaporate as fast as it appeared, but it does mean the physical market has less cushion than many people assume. Let's talk about something that affects silver but often goes unnoticed. Currency dynamics. Silver is priced in dollars globally. When the dollar strengthens, silver tends to fall, even if nothing else changes. When the dollar weakens, silver tends to rise. This relationship isn't perfect, but it's powerful. Right now, the dollar is facing contradictory pressures. On one hand, it's still the world's reserve currency. It's still the safe haven in times of global stress. And when things get scary, money flows into dollar-denominated assets. On the other hand, the fiscal situation in the United States is deteriorating. The debt burden is growing. The political will to address it is absent, and the rest of the world is slowly, quietly looking for alternatives. We see it in central bank behavior. Countries are diversifying reserves. They're accumulating gold. They're building currency swap arrangements that bypass the dollar. They're testing digital currency systems that could one day reduce dollar dependence. This isn't happening overnight. It's a slow process, but it's happening. And if it accelerates, if confidence in the dollar erodes meaningfully, silver and gold will be among the biggest beneficiaries. At the same time, other currencies face their own challenges. The euro, the yen, the pound, all of them backed by governments with similar debt problems and similar political constraints. This is why some investors view precious metals not as a bet against any one currency, but as a bet against fiat currency as a concept. A belief that when all paper currencies are losing purchasing power, hard assets will preserve wealth. You don't have to share that belief completely to recognize that currency pressure creates tailwinds for metals, and those tailwinds are building. I want to spend a moment talking about mistakes, because in times of volatility, people make predictable errors that cost them dearly. First, don't make decisions based on emotion. If you're feeling euphoric because silver is rising, you're probably about to do something stupid. If you're feeling panicked because silver is falling, same problem. Emotions are the enemy of good investment decisions. Second, don't use leverage you can't afford. Silver's volatility can amplify gains, but it can also amplify losses to the point of total wipeout. If you're borrowing to buy silver, if you're using options or futures without deep understanding, you're gambling, not investing. Third, don't follow the crowd blindly. Social media is full of people making bold predictions, posting screenshots of their gains, promising the moon. Most of them have no idea what they're talking about. Many of them have conflicts of interest. Some are simply trying to pump their own positions. Do your own research. Understand why you're buying or selling. Make decisions based on analysis, not on what some stranger on the internet said would happen. Fourth, don't ignore the rest of your financial life. Silver is not a replacement for a diversified portfolio. It's not a replacement for building skills, advancing your career, managing debt, or saving for retirement. It's one tool among many. Fifth, don't expect to get rich quick. Yes, silver can move fast. Yes, people have made fortunes in precious metals. But for every success story, there are dozens of people who bought at the top and watched their capital evaporate. Approach silver with the mindset of protection and patience, not lottery tickets and Lambos. Finally, don't forget about taxes and storage. Physical silver takes up space. It needs to be secured. And when you sell, in most jurisdictions, you owe taxes on the gains. These practical considerations matter. Plan for them. We need to discuss interest rates because they're central to understanding where we are in the cycle. When rates are low, precious metals look attractive. There's little opportunity cost to holding an asset that doesn't pay interest. When rates are high, bonds and savings accounts compete for the same capital. For the past 2 years, we've been in a high-rate environment relative to the previous decade. Central banks raised rates aggressively to fight inflation. That should have crushed silver. But here's what happened instead. Investors started questioning whether rates could stay high given the debt burden. Every rate hike increases the government's interest expense. Every quarter point makes the fiscal math harder. Eventually, something has to give. Either inflation remains sticky and rates stay high, which threatens to break government finances and trigger recession, or rates come down, which could reignite inflation and devalue currencies. Neither path is particularly good for traditional assets. Both paths are potentially supportive for hard assets like silver. We're watching this play out in real time. Central banks are caught in a trap of their own making. They can't normalize policy without consequences. They can't maintain emergency policy forever without consequences. Silver is sensitive to this because it sits at the intersection of real economy demand and monetary system stress. When that stress increases, silver tends to respond. Let's talk about how people think during periods like this, because understanding psychology is just as important as understanding economics. When markets are stable, investors become complacent, and they extrapolate the recent past into the distant future. They take on risk without fully appreciating it. They believe that volatility has been tamed, that the system is stable, that nothing bad will happen. Then something breaks. A shock arrives. And suddenly everyone remembers that markets can go down, that portfolios can lose value, that the future is uncertain. This is when emotion takes over. Fear, greed, panic, euphoria. These emotions drive decisions that look absurd in hindsight but feel compelling in the moment. The investors who succeed long-term are the ones who prepare for uncertainty during calm times, who build positions when no one cares, who have the discipline to hold through volatility without letting emotions dictate action. Right now, with silver experiencing this price shock, we're seeing both ends of the spectrum. Some people are panicking, convinced they're about to lose everything. Others are euphoric, convinced they're about to get rich. Both groups are probably wrong. The reality is, likely more mundane. Markets will continue to fluctuate. Silver will rise and fall based on an evolving mix of factors. Some people will make money, others will lose it, and most will simply hold, watching the drama unfold. Your job as a thoughtful investor is to stay grounded, to remember that volatility is normal, not exceptional, to understand that market cycles exist, that they play out over years, that trying to time them perfectly is a fool's errand. Focus on principles, position sizing, risk management, time horizon, understanding what you own and why you own it. These things matter far more than predicting where the price will be next week or next month. Step back for a moment. Look at the world as it is, not as we wish it to be. We have a global economy built on debt. Governments, corporations, and households all carrying record levels of obligation. That debt needs to be serviced, and servicing it requires either growth, austerity, or debasement. Growth is slowing. Demographics are unfavorable in developed nations. Productivity gains are harder to achieve. Political dysfunction makes reform difficult. Austerity is politically toxic. No one wants to cut spending. No one wants to raise taxes meaningfully. Every interest group fights to protect its piece of the pie. That leaves debasement, inflation, the slow erosion of currency purchasing power. It's not a conspiracy. It's simply the path of least resistance for governments that have promised more than they can deliver. This doesn't mean hyperinflation. It doesn't mean the system collapses tomorrow. It means a long, grinding process where savings lose value, where hard assets reprice higher, and where those who understand the game protect themselves, while those who don't slowly fall behind. Silver, like gold, like real estate, like productive businesses, offers a way to participate in that repricing. It's not perfect. It's not guaranteed. But it's a hedge against a system that has few good options left. Understanding this helps you weather volatility, because you're not betting on a price. You're positioning for a structural shift that will play out over years, perhaps decades. So what should you actually do? Let me offer some practical guidance. If you own silver, review your position. Make sure it still makes sense given your overall financial situation. Make sure you're not overexposed. Make sure you can handle the volatility without losing sleep or making emotional decisions. If you don't own silver but you're interested, educate yourself first. Read about monetary history. Understand how precious metals have functioned during different economic regimes. Learn the difference between paper and physical. Understand the tax implications in your jurisdiction. Then, if it makes sense for you, start small. Don't try to build a full position overnight. Average and over time. Get comfortable with the volatility. See how you feel when the price swings. Whether you own silver or not, focus on the fundamentals of sound financial management. Build an emergency fund. Pay down high-interest debt. Invest in yourself and your skills. Maintain a diversified portfolio appropriate for your goals and risk tolerance. Silver should be a component, not the center of your financial life. Stay informed, but don't obsess. Check in periodically. Read analysis from credible sources. But don't watch the price every day. Don't let market movements hijack your emotional state. And remember that no one knows the future. Not the analysts on television, not the gurus on social media, not me. We're all working with incomplete information, making probabilistic bets, hoping to be more right than wrong over time. Humility is a virtue in finance. Confidence without arrogance. Conviction without certainty. These are the qualities that serve investors well. We've covered a lot of ground today. The sudden price, shock in silver, the macroeconomic forces driving market behavior, the historical context, the psychology, the practical considerations. Let me leave you with a few final thoughts. First, what's happening in silver right now is a symptom of larger issues in the global financial system. You can own silver or not own silver, but understanding those issues matters regardless. They affect your job, your savings, your cost of living, your future. Second, volatility is not the same as risk. Volatility is short-term price movement. Risk is the permanent loss of capital or purchasing power. Don't confuse the two. An asset can be volatile but low risk over long time horizons. An asset can be stable but high risk if it's slowly losing value to inflation. Third, the best time to make decisions is before emotion enters the picture. Build your framework now. Decide what you believe about markets, about money, about the future. Then stick to that framework when things get crazy. Fourth, No investment is worth sacrificing your peace of mind or your relationships. If owning silver or any asset makes you stressed, obsessive, or difficult to be around, you're doing it wrong. Step back, reassess, adjust. And finally, remember that markets reward patience, discipline, and clear thinking. They punish emotion, leverage, and overconfidence. Those rules don't change just because silver is moving or because the world feels uncertain. The crisis some people are talking about isn't new. It's been building for years. What's new is that more people are starting to notice. That awareness creates opportunity for those who are prepared and risk for those who aren't. You get to choose which category you fall into. Stay informed, stay disciplined, stay grounded. And remember that understanding cycles and preparing thoughtfully will always matter more than reacting to headlines. Thank you for watching. Take care of yourself, take care of your finances, and I'll see you in the next one.